That was, of course, John McFarlane of Barclays in his capacity as chairman of Citi UK. Now let's bring in our panel of guests. George Buckley is Deutsche Bank's chief UK economist, Ben Southwood from the Adam Smith Institute, and Mark Gilbert from Bloomberg TV. Gentlemen, thank you so much for sticking around. Mark, when you look at the Brexit debate, right, how should investors think about Brexit and what it means for the BOE? Mark Carney cannot give a political message out by either raising or cutting interest rates right before a referendum.
It's another reason not to move, along with the laundry list, which George explained earlier. And I think one of the ways to think about Brexit is to look back at the Scottish referendum, which got absolutely to the cliff edge before the government realised, hang on, we might lose this. This will be messier, it'll be nastier. It's got much more domestic political ramifications within the ruling Conservative Party and how they're going to deal with internal divisions as this goes forward. You don't want to be holding a currency at a time when a government is in disarray, and that looks likely to persist for months.
And George, back to your point. March looks less and less likely. I think you said March or May. I mean, we're not really going to have an interest rate hike before the end of the year, right?
Unless we see inflation starting to move up more aggressively. What could be more important here, well, oil prices aren't going to be that reason. They're falling even further. They're pushing downward pressure on near-term inflation. They could put upward pressure on inflation in the longer run, because as people have more money to spend, they go out and spend it on core goods and services, it drives the prices up. So it might not necessarily be disinflationary over the longer term. So what the Bank of England it's really important for them to do is to concentrate and focus on core inflation. Just as they looked through inflation when it got to over 5% in 2008, 2011, look through it also when it's very low, because you could be seeing some underlying inflation pressures eventually coming through this year.
What do you need to see to change your forecast then? What makes you take off this year as a rate rise?
I think the two things that the bank is not raising rates because of primarily are wages and prices. Wage inflation has been very weak. It's fallen for the last 3 months. It's disappointed. It was on a rising trend. It's now started to soften. Inflation itself lower because of oil prices. And even though that's non-core, I think the bank is going to be very reticent, given that they have a mandate of keeping inflation at 2%, to raise interest rates when inflation, headline inflation, is still below a level at which they have to keep writing letters to the Chancellor to explain why they're not getting it right.
George, why has wage growth not been as fast as we were expecting it to be?
I think there's a lot of reasons. I mean, one of the reasons which the Bank of England has done some research on is the fact that the number of people coming into the labour force, they are actually in lower paid jobs, and the wage numbers are not mix adjusted. So that is pulling down on wages. You're not looking at like for like, and that's one of the reasons. But also, it looks like we've had a change in the relationship between unemployment and wages over the past few years.
Ben, when we look at inflation, and whether we look at the Bank of England or the ECB or any other central bank, I mean, do they really have a power to change inflation at all in this kind of environment? It seems that it's completely out of their control.
I think the Bank of England could generate more or less as much inflation as it wanted if it were willing to, but I think its goal of bringing inflation back to its 2% target within the next 2 years, basically, they're essentially keeping to that, and they think that all of the pushes down on inflation we have now are temporary, by which they mean supply side. They think it's coming from things outside of their control. They know they can control aggregate demand, they could print lots more money, they could do lots more QE if they wanted to, and they think, I think they believe they could create more inflation if they wanted to, and they would do so if we were at 0% or lower inflation, because there wasn't enough spending in the economy. But if you decompose inflation into supply side and demand side moves, it looks like inputs from abroad are driving it down. It looks like mainly stuff like oil is why we have low inflation, not because people aren't spending, not because people aren't investing. And so I think they're worried about, rightly, their mandate, which is to think about the demand side of the economy. So I think they're doing a pretty good job within the remit of what they've got. And I think that they could create inflation if they wanted to, and they've decided not to.
Okay, interesting. Mark, we look, of course, at central banks, and we look at FX, and there's not a single central bank in the world that would say, oh, yeah, we're targeting FX, and this is something that we watch out for. But actually, is there an ideal level
this hidden currency war that's been going on for a couple of years? And I don't think there is an ideal level for the pound. The weakness, as George said, might well be welcomed as a way of actually stimulating some inflation. I want to put something different out there, though. You're Ian McCafferty. You've been voting for higher rates. What do you do today? I think it's very, very hard to tick the box that says, yep, higher rates, given what we've seen in the markets this year. And I'll give you another one. If you're Andy Haldane, do you vote for a cut? given what he's been saying in his speeches recently about the risks that he sees in the global economy. And let's face it, the global backdrop could not really be worse. It's as bad as anyone, even the Albert Edwards at SocGen, the biggest bear in the market, arguably. The global backdrop's about as bad as it ever gets. You're not going to ask for and you might well ask for rate cuts.
I think the global outlook in terms of market outlook, absolutely right, it is worse than expected. But when you think about the fundamentals underlying that, I mean, certainly our forecasts for China are nowhere near as bad as some of the market moves which have been responsible, or China has been responsible for, have suggested. So I don't think the fundamentals are anywhere near as bad as some of these market moves that we've seen.
But hold on, Joe. I mean, we had, industrial output was worse than expected. Manufacturing was worse than expected. So we're seeing domestic pressure here in the UK.
Yeah, for sure. When you look at economic growth, it's not been as strong as it was. I mean, 2014, the average growth rate was 0.7% Q-on-Q. So far in 2015, in the first 3 quarters that we have, it's 0.4. The PMIs are down, the surveys are softer. So there are some signs that things aren't as strong. But we're still forecasting 2.5% growth this year, which would not be a bad outcome.
So no chance of a cut this year?
I'm sure there always is a chance.
Or at least a vote on a cut.
I'm sure. I wouldn't be surprised if someone does vote for a cut. And of course, there are some obvious contenders, as you suggested, Mark. It's a risk.
I think the obvious policy, if it was me, would be to vote for more QE if you thought things were that weak. But I think that basically these are things that are outside the Bank of England's control. They're making sure the economy is ticking over well on the demand side, and there's no need to move policy in any direction at this moment.
As long as you think QE is working.
I think QE is working, yeah.
Maybe a little bit is working?
I think that maybe the way to look... The ECB's come late to the party, and it's certainly not working in the Eurozone, that's for sure. If you look in the options market, expectations of what the Fed's going to do. At the start of the year in the options market, there was a 52% chance of the Fed raising rates in March, the second increase. This morning when I looked, 37% chance, which means there's more than a 60% chance you don't get that second Fed rate increase. And that's because people think the global backdrop has deteriorated.
But why would you say that Eurozone QE hasn't worked? I mean, since they've announced it, we've basically seen the only of a recovery in the Eurozone that we've ever had. And if you look at all the empirical studies of whether QE has worked in the UK or in the US, we've seen substantial increases in real GDP and inflation due to QE, according to these studies. I find it very hard to say that QE isn't working.
A lot of research is saying that that's, of course, because of lower oil prices, which means that it's cheaper to manufacture, and that QE probably only had an impact on FX. Because I'm not biased either way, but one could argue, George, that actually QE only works during a financial crisis.
I suppose my answer to that would be a typical economist answer. You just don't know the counterfactual. No one knows what we would have done had we not had any QE. I suspect things would have been substantially worse.
Well, Peter Brett's saying a depression if we hadn't intervened, and he says if we print enough money there will eventually be inflation. But if you look at inflation expectations, the five-year forward rate, if Mario Draghi says we are measured on our policy success or failure, and in terms of getting to 2% inflation in 2 years' time, it's a failure.
Ben?
No, that's a fair point. I would agree they haven't achieved their goals, but I don't think they haven't pushed in the right direction. I think that QE is clearly a step in the right direction, and if you do it better, say it's open-ended, say you're not going to withdraw it once it runs out, and so on, and if you say that you promise to do enough to achieve your goal, that whatever it takes, but actually sticking to whatever it takes, then I think you can always hit your targets as a central bank. I think that basically what we've done in the UK and the US shows how QE is clearly better than non-QE.
Okay, guys, thank you so much. And we also had a great chart from the five-year. What a great conversation. George Buckley from Deutsche Bank, Ben Southwood from Adam Smith Institute, and Bloomberg View's Mark Gilbert. I like counterfactual. Such an economist, George, such an economist. Now let's get straight to the Bloomberg Business Flash.